Ladies and gentlemen, welcome back to Driven Wyld. Today we are talking about determining your tax filing statuses. So we as gig workers understand that we are making a form of income that is outside of a W-2 job, which is awesome in my opinion. But there begs the question of something that we have yet to really talk in depth about. How does our filing status, being in a lot of cases involving our significant others and their filing status? More than I thought, to be honest. So with that said, we are talking about everything you must know about determining your tax filing status, how it actually works, and everything in between. But before we do that, let's go over a quick disclaimer. The content of this video does not contain, is never intended to be, legal, business, financial, tax, or health advice of any kind. This video is for entertainment purposes only. It is advised that you conduct your own research and consult qualified professionals before applying anything you find online. Also, thank you to GigTax for verifying this information and making this video possible. Determining your filing status. One of the important details that must be determined is which filing status you fall into before we even talk about how much money you make. There are 4 categories that you can fall into: single, married and filing jointly, qualifying widow or widower filing status, married and filing separately filing status, and head of household filing status. Now, some of these are self-explanatory, being single exactly as it sounds. You're forever alone in filing your taxes this year. Okay, that was harsh, but you get my point. But some statuses are a little bit more involved and require a bit more attention. What does qualifying widow actually mean? A widow is somebody who has lost their husband or wife when they died, which is already emotionally traumatic on its own, let alone the financial aspect of that. A qualifying widow, in terms of tax brackets, means that they can use this status, for better or worse, to file their taxes as if they are still married, despite the fact that their partner is deceased. This can help tremendously with removing the financial burden from the surviving spouse's shoulders of losing their significant other, and the financial burden of losing an income source, no matter how callous that sounds. You can file taxes as a qualified widower for the year your spouse died, as well as 2 years following their death. So depending on the timing of when their spouse passed during the year, this time frame can technically be 3 calendar years. After that, you must opt for the status of either single filer or head of household. But what qualifies someone to use this filing status? Well, there are a few specific rules on the subject. You are entitled to file a joint return with your spouse for the year your spouse died. It doesn't matter if you were actually going to file a joint return, you are entitled to do that. Your spouse died for the previous 2 years and you didn't remarry before the end of the ensuing year. For example, if your spouse died in 2018 or 2019 and you were unmarried as of December 31st of 2020, you could still file as a qualifying widower for the tax year 2020. I can't imagine somebody getting back on the horse that quickly after their significant other died, but okay. You have at least one child or stepchild, not a foster child, living with you who you can claim as a dependent. Imagine adopting a kid just so that way you could file your taxes differently, though. That'd be hilarious. It'd be pretty messed up, but it'd be hilarious. Keep in mind that you don't actually have to claim them on your tax return, but they must technically qualify as one. When my mom passed away, my stepfather was left as a widow of that marriage, but because all of his kids and my mom's kids, being me and my sister, were old enough to take care of themselves and don't qualify as dependents, he couldn't qualify in this regard. You paid more than half of the cost keeping up the home for the year, expenses for the home upkeep, including groceries to rent or mortgage, homeowner's insurance to property taxes, repairs, utilities, and other home maintenance fees. So as we said earlier, if you qualify, you can maintain the marital marital tax brackets for the next 2 years, but after that, you're gonna have to switch to single filing status or head of household. What does head of household actually mean? The head of household status is generally tied to marital status, with married taxpayers having the option to file jointly or separately. Generally, people who have never been married or who are legally divorced or separated at the end of the year should use the single filing status. But there are some unmarried taxpayers that can use the head of household filing status, but you must meet certain requirements. And that includes the following. You are unmarried or considered unmarried on the last day of the year. You paid more than half the cost of maintaining the household for the tax year. You had at least one qualifying person living with you for more than half the tax year, except for temporary absences like attending college. And qualifying dependent parents don't have to live with you. Let's say your 18-year-old son lived with you and paid half of all the household bills. You can't claim the head of household status. You can only claim the head of household if you paid more than half, which would be at least 51% of the total household expenses. Now, once you've established that you paid more than 50% of the expenses of your home, you must also meet the requirements for your qualifying person that you claim as a dependent. Which is better, jointly or separately? Generally, married filing jointly is more generous due to the wider tax brackets and bigger standard deduction. For example, the 10% bracket kicks in with $22,000 in taxable income for joint filers, which for singles would be $11,000. Although there are some scenarios that would make it worth filing separately. Phantom tax. For those of you who have earned a higher education and have some student loan debt, there is a concept known to most as phantom tax. This is a term coined by Marianella Collado, a CFP and CEO of Tobias Financial Advisors, and she is also a CPA. Income-driven student loan payments factor in earnings from your most recent tax return. That means a lower earning spouse with student debt could see significantly higher monthly loan payments by filing taxes jointly. You could avoid the phantom tax of higher monthly student loan payments, but you may owe extra taxes by filing separately. So I would consult with a tax professional to see what would actually make sense for you on a financial level. Maximize itemized deductions. Another reason that someone should file separately is to maximize itemized deductions, such as the tax break for medical expenses or charitable gifts. For us as gig workers, this could be for a sole proprietorship that is writing off miles or other expenses of their business. Each year, taxpayers choose a standard deduction or itemized deductions, whichever is greater. For 2023, the standard deduction is $13,850 for filing separately, which is easier to exceed than $27,700 for filing jointly. Now, one of the things I was a little confused on is if one spouse itemizes, the other can't take the standard deduction. At least in my mind when I heard that. That can increase the tax liability for you or your significant other, so it really should be one or the other, right? Not necessarily. Itemizing expenses or standard deduction on Schedule C doesn't mean that someone will have to take the itemized deduction on their 1040 form. That was confirmed by Joseph Mayo, founder of GigTax. Penalties for filing separately. While filing separately may offer savings in certain scenarios, there could be other unexpected tax consequences. Separate filers typically can't make Roth individual retirement account contributions because their modified adjusted gross income limit hits $10,000. Plus, you may lose credits as the tax break for child and dependent care, education, and student loan interest, among others. Now, most of these opportunities are less like penalties and more like not applicable, but the fact remains that you may end up being better off filing jointly. Of course, this is a very important discussion to have with your tax professional to discuss your personal situation, what is right for you, which is where GigTax is here to help. Filing your taxes on time, promptly, and accurately is an inevitable aspect of being in business for yourself. That is where GigTax is here to help. For every hour spent on navigating tax season alone, you miss out on potential earnings, precious moments with loved ones, and expose yourself to financial risks. Recognized as the leading tax preparation service for gig workers, GigTax is dedicated to simplifying the process, saving you time, energy, and money. Founded by Joseph Mayo, a seasoned gig worker with over 6,000 deliveries across 6 different platforms since 2020 and growing, GigTax addresses the overlooked, overcharged, and underserved needs of gig workers in the financial realm. Driven Wyld subscribers can take advantage of an exclusive 77% discount on GigTax's tax prep, bringing the price from $538 to $124. Act now to get this price before GigTax's calendar is booked. Because GigTax helps people just like you make the wisest and most effective decisions on your business and personal tax needs all year round. Secure your spot today with GigTax using the description link below to register and enter Wyld to maximize savings and get back to what you do best, making the most amount of money in the least amount of time in the safest possible way. Thank you so much for watching. I really appreciate it. As always, make sure to hit the like button, subscribe if you're new, and I'll see you guys next time. Peace.